Hi, I'm Max Keiser, and this is the Keiser Report. Remember the financial disaster of 2008? Well, the rumor was at that time that the only available source of cash were the drug cartels, because all the money on Wall Street was being, well, had evaporated because Wall Street runs on one enormous Fed-backed credit card. Nobody had any actual cash. Well, here's a story from the New York Times. Wachovia Bank is going to pay $160 million to settle a drug money laundering case. Wachovia, by the way, was bought by Wells Fargo. Wells Fargo, biggest shareholder is Warren Buffett. And here we see Warren Buffett in an ad that just came out, pumping his company Geico, the insurance. And if you look very carefully at Warren Buffett here, he looks like he's been imbibing of that very famous product from the Mexican drug cartel. Check this out. All right, let's get all the latest markets, finance, and scandals from Stacy Herbert.
Max, just a little update on our last episode. Here's a headline that goes with that. Irish police said to arrest former head of bank. This is Sean Fitzpatrick, the former head of Anglo-Irish Bank. Remember, he was forced to step down from the bank in 2008 when they discovered that he had many tens of millions of euros of loans to himself that he had failed to declare.
Yes, it's a scandal, isn't it? The Irish bankers are committing massive financial fraud.
That's right. Now, the next headline, I thought you would have unique insight for the Keiser Report viewers. Dear Mr. Keiser, we Greeks want you as president. This is from omadion.wordpress.com. And apparently, the Greek people saw you being interviewed on the news, and they decided that there was a quote on the YouTube, "We want that guy, Max Keiser, for president." And so the Greeks have introduced this poll, and 97% of you either want you as president or finance minister.
I'm willing to accept the presidency of Greece. And because people saw me, they translated a news appearance I was on into Greek, and the Greek people saw this, and they realized, oh my God, here's a guy who actually knows something about the financial system. And I've been warning the people of Greece that the IMF, which is just a surrogate for the World Bank and Wall Street shysters, is coming at you, is coming for you. The IMF is debt slavery. No IMF, but of course the government in Greece is corrupt, so they'll let the IMF in.
Well, that takes me to the next headlines. Greece may seek IMF help by Easter weekend. That's April 2nd through the 4th. And then the headline that accompanies that, Germany seeks IMF role for Greece, CDU lawmaker says. So this is Michael Meister, the chief financial spokesperson for Angela Merkel's ruling party, and he said that Greece should turn to the IMF. So it sounds to me like it's a game of chicken between the two, because, of course, the other European leaders, including Sarkozy and Jean-Claude Trichet and Jean-Claude Juncker, they don't want Greece to have to go to the IMF because that's America. So they want to be able to deal with their own problems.
As I've said on the show every week, that Germany would never come to the aid of Greece. They will eventually flip it over to the IMF. And the IMF is debt slavery, and austerity measures in Greece are only going to get worse and worse and worse. And yes, I accept the nomination for president of Greece because the current government is completely corrupt, and I'll throw them all out. Regime change in Greece! Make me the president!
Here's a headline, speaking of Germany. Sinister German spy plan aimed at hedge funds, analysts say. So Germany's finance minister, Wolfgang Schäuble, told the Bundesbank on March 16th that the country may have to consider ordering intelligence agencies to set up surveillance of who is getting together with whom for which kinds of speculative processes and where to protect the euro. Now, Vanessa Rossi of Chatham House of this said, within continental Europe, there are those that do think that financial speculators are sort of terrorists. In their lexicon, it is economic terrorism, so they may view this as more serious than the U.S. and U.K.
It is financial terrorism, as we've been saying on this show for weeks, as we've been reporting about for the last few years. It's savers versus speculators. Anybody with a job or savings is having their wealth confiscated by borrowers and speculators. Ben Bernanke, of course, is going to keep rates low because it favors borrowing and speculating.
But just on the other side of the equation of this story, there's Jacob Schmidt, who is a hedge fund advisor in London, and he says hedge funds are very nice targets because they are particularly based in London and New York. He, meaning Wolfgang Schäuble, the finance minister of Germany, he is not going to say this about the German banks. And that's a good point to make because at the beginning of the financial crisis, a few names were very central to it all, including Deutsche Bank, which was one of them. But no mention of Deutsche Bank is made in these comments.
Well, yeah, of course. Well, Deutsche Bank is just one great big hedge fund.
Now, speaking of currency speculation or reform, here's a headline. Pak Nam-gi, North Korea finance chief, reportedly executed over failed currency reform. So North Korea executed a senior official last week as punishment for the country's botched currency reform. Remember, in November, North Korea suddenly introduced a new currency, and now apparently it's gone down very badly because it's caused markets and sparked anger among many North Koreans left with piles of worthless bills.
Congratulations, Tim Geithner. You just won an all-expense-paid trip to North Korea.
Well,
yeah.
Speaking of market manipulation,
yeah.
Here's another headline, and this is one that we actually predicted, or you did here on the Keiser Report. Obamacare prediction market was briefly manipulated yesterday evening so it would artificially close at $35. Mm-hmm. So I have the charts here.
Yes.
And you see at following 4:04 p.m. on March 16th, the price of Obamacare passing by June 10th contract on intrade.com plunged from $65 down to $35.
That's right. We said that the market was susceptible to manipulation. Within a few hours, we had a demonstration of the market being manipulated. These markets, like all markets, are part of the rigged market capitalist system, and they're being used by puppets, by prognosticators, by pundits at the New York Times, like Paul Krugman, will manipulate this market, and he'll say, oh, look, the price says we should all buy into Obamacare. And they use that as consensus that Obamacare is being accepted by the people, even though the price is being manipulated. And it was shown quite convincingly that all the buying was coming in from Washington, from people who support Obamacare, and this is the pharmaceutical company, the insurance industry, who are all going to basically get a huge government subsidization, multi-billion-dollar gift as a result of Obamacare. And this prediction market is totally manipulated.
But there's another manipulation story in the news. SEC, hacker manipulated stock prices. So U.S. authorities have seized the assets of a St. Petersburg-based fund, Broco Investments. They said that Broco capitalized by artificially moving prices of more than 38 thinly traded securities, enabling them to profit from up or down price swings. The SEC's quote says, these transactions have created the appearance of legitimate trading activity and have artificially affected the prices of at least 38 issuers.
Right, the appearance of true price discovery using these sophisticated high-frequency trading or program trading you read about. And I'm talking to somebody right now who's coming out with a major story about this, how the banks on Wall Street, principally Goldman Sachs, they use this high-frequency trading, algorithmic trading to make it look like legitimate trades are going on. But in fact, there's a lot of market manipulation and wealth confiscation going on as they basically siphon off billions. I mean, Goldman Sachs reported something like 20 or 30 straight days, $100 million days in a row. I mean, they don't, because they put their risks into the public domain and they only keep their rewards. That's not business. That's called stealing.
They call this the hack, pump, and dump scheme, but they fail to mention the government's own manipulation of markets for perception purposes, to convince people to get into the market, to convince pension funds to take the passive investors' money and put it into the market.
Right. I mean, that's a good point. The prices are manipulated so that the government can get this passive money like pension funds to go in there and basically lose their shirt because after the pump and dump scheme is over, they simply pull the bid and all the crooks leave town with the cash. But it's being used on the political markets as well, like Intrade. They're using markets like Intrade that are political betting markets to get the public to buy into what is effectively a manipulated outcome. This is a new, this whole idea of propaganda. This is a market-enabled form of propaganda.
So now when you are pumping and dumping via the government to create the illusion of a healthy economy, a vibrant economy. This goes with that. Now Bernanke wants to eliminate reserve requirements completely. So this is a quote from the Federal Reserve's website. The Federal Reserve believes it is possible that ultimately its operating framework will allow the elimination of minimum reserve requirements, which impose costs and distortions on the banking system. So it's not the cheap money that creates distortions and the misallocation of capital. It's the fact that there has to be even minimal reserves held by the banks.
See, the problem is that under a fractional reserve model, the bank might have $1 deposits and they lend out 10. Now, the problem in the last 2 years is that regulators and the public want to know, what about that $1? Because if that $1 is at risk, then our entire economy is at risk, and we want you to prove that you even have $1. So Ben Bernanke, instead of saying, well, here's what we're going to do, we're going to prove we have the dollar, he's going to say, let's just get rid of the dollar completely. Let's just have no reserves whatsoever. It'll all be based on algorithms. It'll all be based on computer programs. And just trust us that we'll know how to run the economy without any reserve requirement whatsoever. And by the way, if you go to get your money, Citigroup just said you have to put like a 7-day waiting period to get your money. If you want your money out of the bank, you're a terrorist. If you want your money, you're a terrorist. We've got your money. Don't worry, we've got your money. Yeah, well, it's absurd. I mean, this is financial terrorism. I mean, Ben Bernanke is basically, he's taken over where Al-Qaeda has left off. He is basically the Osama bin Laden of the 21st century.
Well, he's encouraging, it's totally virtual now. There is no reality. First, America went from a currency backed by gold to something that was just pure fiat and in God we trust and in the Federal Reserve we trust, and now it's to nothing. But this is also encouraging people to take on more debt, which is exactly what we don't need, which is exactly what caused the crisis. So final headline, it's official. We've still got tons more deleveraging to do. Now, take a look at this chart. This is from Annaly Capital. The line in the green is the financial sector debt to GDP. The line in the blue, which is the important one to look at right now, is private sector debt. And the red one is government sector debt. Now, private sector debt is now 97% of GDP, debt to GDP. Now this, to get down to just semi-normal level, historical average of 60%, would require $4.9 trillion more of deleveraging by the consumer in America. Now, to put that into context, they've only deleveraged by $300 billion at this point. So you saw how much that deleveraging has created chaos. Government also, as you see from the chart, you see the red line, they need massive deleveraging as well. And financial sector also needs several trillion more of deleveraging.
Woo! Well, it sounds like more deflation coming our way. Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. When we come back, I'll be talking to Gregory White of Business Insider.
Of particular faces form the face of a country. RT presents to you the entire variety of peoples inhabiting Russia.
Hi, and welcome back to the Keiser Report. We were just talking about massive deleveraging. So let's welcome Gregory White from BusinessInsider.com to the Keiser Report. Welcome, Greg.
Thanks very much, Max. Pleasure to be here.
All right. Now, Gregory White, you've got a report out. SocGen, there's no way out of this mess but continued massive deleveraging. They've written a report. You're talking about this report. Tell us about it. What are the key findings of this Societe Generale report?
Well, the report points to the fact that there's really no way out of the current crisis that we're in, which started with the credit crisis and expanded to the banking crisis and then became a full-fledged sovereign debt crisis without massive deleveraging. And that's not just a deleveraging by individuals or companies, it's deleveraging by governments as well. There's no way to trim the fat other than actually going back and getting rid of the leverage that's on the books for every single level of our society, pretty much.
Okay, so let's talk about this for a second. In other words, we know, for example, from the Lehman Brothers scandal this past week, that Wall Street and their enablers engage in all kinds of scandalous off-balance sheet financing. And it sounds as if there are hundreds of billions of dollars worth of debt still out there yet to be disclosed. And this is the problem in terms of when this deleveraging that has yet to materialize. It's because these banks have yet to come clean. Is that basically correct?
That's a large part of it, absolutely. I mean, if you look at the balance sheets of both governments and banks, you see that everything's not being revealed in a manner which is clear. You know, the assets have not been specified. Things have not been identified in a manner in which it's very clear how much leverage is actually on the books of these banks. You know, they have things in special investment vehicles and a lot of other instruments where they can hide their losses most creatively. So until they're honest about where they actually stand, we won't actually be able to move forward in terms of getting rid of the leverage that's on the books at banks. And governments face the same problem to a certain extent.
Well, it seems like every time the economy shows any kind of spark of life, then the banks can just open another magic door and say, oh, here's another $100 billion worth of debt we failed to talk about, and it snuffs out any recovery, and it's just a way for the banks over time to get the public to finance all their bad debts. I mean, isn't that basically what's going on?
Well, you could say that the banks are doing a very good job of managing their position in this crisis. They don't want to reveal too much too soon because that will scare off governments from providing more money to shore up their capital. But the reality is these banks still have these things on their books. They're unwilling to reveal it. And yes, every time the economy seems to get a bit better, they seem to be revealing more. But the reality is, as the economy grows, if this growth is to continue in a real way, they will be able to pay down a lot of these debts that have been on their books. But the reality is, if they were to reveal these all right now, there's no way that growth could continue because people would just become so adverse to spending, banks, corporations, governments, that the ability for the economy to grow would diminish, and therefore their ability to pay off that debt would evaporate.
Okay, let's talk about the other side of the equation, which is that now Albert Edwards, the author of the report, talking about more deleveraging yet to come. He's talking about once this gets through the system, double-digit inflation, because monetization is the policy of first choice for governments. Is this when the debt load is finally chewed through, and let's say velocity of money kicks in, isn't the other side of this a kind of massive, some have called it potentially hyperinflation. Isn't that the risk on the other side?
Well, of course, there's some tail risk that the potential for hyperinflation exists. But I think the reality is that hyperinflation is something that you get into at a very unique scenario. You'd have to see an international crisis erupt to drive that sort of hyperinflation. I mean, there's states that look right now that they have the chance to enter into something like that. I mean, a small chance. We don't want to overestimate this sort of thing. But the UK and the United States, with the amount of debt they have on their books, will be in need of increasing the money supply to a point where they're actually printing so much money that, yes, inflation does increase and could increase dramatically. But they've done a good job thus far of managing that problem. The question is whether or not in the future they'll be able to do that when they actually look to more aggressively deal with those debts.
All right. So your position is that they are threading the needle successfully between these two opposing forces. Some might argue that the overall economy, with the rising unemployment level and other factors, maybe not so successfully. Let's talk about Christopher Dodd for a second. He's chairman of the Senate Committee on Banking. He's introduced a new a new bill through Washington. Tell us about that.
Yeah, the new financial regulation bill that Chris Dodd's put together as chairman of the Banking Committee is essentially looking to overhaul everything that's been in place before in terms of regulation in the U.S. government. But it's not really actually changing the underlying rules of the game for banks. It's not altering the way they do their business. It's not saying you have to have more capital reserves in order to handle a crisis like the one we've just through. It's actually just saying here's more people to watch to make sure and see where the next crisis is going to come from. And in that, it's pretty timid.
All right, now, a moment ago, we were saying that the reserves of the banks are not being all the balance sheets of the banks are not being stated. Dodd's talking about the necessity for a greater accountability in terms of reserves in the banking system. Now we've got a statement coming out from Ben Bernanke, Fed chairman, who's saying that, you know what, we want to go to a system without any reserves whatsoever in the banking system, zero reserve banking. Does that make sense to you? What are your thoughts on that?
That doesn't make any sense to me. The underlying problem that got us into this mess was banks were not being honest about how much leverage they had on their books, about where they were putting money and what risks they were taking. And what they're doing, if you're getting rid of the rules of the game in terms of leverage, you're not really, and capital reserves, you are essentially stripping away the one thing that you can do, the simple underlying thing you can deal with to control the way banks act in the marketplace. If you don't go back to things like the Basel Accords, update them, make them superior, and really enforce them, really take a look into banks' balance sheet and make sure they come clean about actually what they have on them, then you're not going to stop another crisis like this from occurring. You have to deal with the underlying factors.
Okay, so for viewers unfamiliar with the Basel Accords, these are basically the banking regulations that state what should be the minimum reserve requirements for banks. And, just to add a little bit more onto the big picture here, a bank are engaged in what's called fractional reserve banking. For every dollar of deposits that are put into the bank can then loan out $9, $10 based on that dollar. And the root of this crisis that we just went through is because during the Greenspan era, they changed those laws to allow banks to lend out quite a bit more than they had on deposit. Remember, I think it was Greenspan in 2004 oversaw the change from 12 to 1 to 30 to 1. And you're stating quite unequivocally that to fix the problem, those reserve requirements need to be at least respected, if not augmented. And there seems to be a conflict with what's happening with coming out of Bernanke's mouth, saying, well, we can do away with reserves altogether. I mean, at what point do these two forces start to clash? Because it seems insane that he would be pursuing a zero reserve banking system, and yet you can understand why he would say that, because if he does, then they have zero accountability whatsoever. They'll never have to show their balance sheet ever again because they're just purely in the algorithmic trading game. There's no capital whatsoever. So at what point do these two forces clash?
Well, I think Chairman Bernanke is setting himself up for disaster in a way. If you take away these requirements for banks, the Fed is essentially saying, well, we didn't know about it. They have plausible deniability in any scenario that comes up. You can create as many systemic risk boards like Dodd wants to do, and as many organizations in the government to look over these facts and figures. But if you can't enforce the real ground rule on leverage and capital requirements, then you're not going to change this at all. And these forces are going to come to clash at some point. But the reality is, I don't think anyone in government and anyone in charge right now in terms of the Federal Reserve has an interest in really changing this and moving towards a more serious approach to dealing with leverage and capital requirements. It's not something that's in this, the interest of the people who work in those industries. It's something in the interest of the American people and in a broader sense of global people in Western democracies to make sure their governments watch over this. But it's not in an interest of the individuals who work in the banking sector or those who work for them in government.
All right, Greg White, you're over there at BusinessInsider.com, which is a fantastic site. It's got really all of the eye candy that any news and finance junkie could ever want. You say on your site that young people should move to Asia. Is that it? American dream's over?
Well, in terms of what I've written about is Jim Rogers, very famous prognosticator, has suggested that moving to Asia now is similar to moving to New York in the early 1900s and moving to London in the early 1800s. It's where you want to be if you want to make the most money in terms of the financial world. So to move to Asia, we're really recommending people to go a very, very safe route. Try to look into the companies they already work for, whether that's in consulting, banking, finance, any other sector, and try to work through them to move to Asia, because it's extremely difficult to get work permits to work in places like China because of the requirements they have on individuals. And it's extremely difficult to do that in particular from the U.S. So to have your company do it for you is much easier. At the other end of that, if you're looking for a year out from the from your life in finance or in consulting, teaching in Asia might be a good place to start. It's a way to kind of inculcate yourself with the language and to better understand the environment there.
Greg White, we've got some questions from our viewers. One from Tony, who asks about this deflationist argument. He can't reconcile that with what he sees as inflation at the point of sale. You know, he sees prices going up, I guess, for food and things like this, and he can't reconcile the two. How would you address that?
Well, I think there's certainly inflation in goods and economies in real terms, and that people are feeling that. But that's also an impact of the unemployment crisis and the lack of growth in the economy. I don't think that we're seeing the sort of catastrophic inflation that people have talked about, hyperinflation. We're not seeing that. What we're seeing is people get impacted more by the little things because of the nature of the economy, the lack of growth, and that costs are rising because the economy is becoming less competitive. So I think, and what's really important is that inflation has drastically gone up in the United States in terms of things like of house prices, of apartment rentals, and education. College education prices have gone up drastically in the last 20, 30 years. And I think people are spending more money on those things, which often don't get counted into the typical inflation percentages. And so it's becoming more difficult to buy the other things, the milk and bread of the economy. So I think that that's certainly something that people need to pay more attention to.
We'll leave it there. Greg White, thanks so much for being on the Keiser Report.
Thanks so much for having me, Max.
All right, that's all the time we have. Thank you, Greg White, for being on the show with my other guest, Stacy Herbert. And if you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.